Hello and welcome. We are going to speak to the management of Medi Assist. Now, just in terms of the big development, they acquired Paramount, which is another player with a decentish size in their space. They're, of course, they're insurance distributors more to the B2B, and what they also, of course, do is enable they're a TPA basically, but to simplify this further, they enable consumers with their claims, with their insurance claims as well. So a plethora of things, but let me, without any delay, welcome on board Satish VN Gidugu, who is the CEO as well as the whole-time director at Medi Assist Healthcare Services Limited. Welcome on board, sir. First off, I want to try and set the context. Your top line, around 150 odd crore added to your top line in terms of this acquisition, taking your top line closer to the maybe 800 crore mark. Just talk us through where margins will start to shape up, because you've made a couple of acquisitions in 2023 which were negative EBITDA margin. How is the Paramount margin currently, and how quickly do you expect it to go to the normalized 20% which you currently operate at?
Good morning, Harsh. Thank you for having me here. You're right. So the Paramount has an operating revenues of about 153 crores, which is over our FY24 as nearly 25% from a top line perspective. Historically, we have acquired other TPAs who had lower single-digit margins. And typically it takes Harsh about 4 quarters, for us to turn the business around, completely move them to our operating model, and then have the consolidated margins showing up. Medvantage integration is fully done. Raksha is in progress, and we expect Paramount, which is currently at about 9.5%, margin, to start getting closer to our margins about 4 quarters, from the date of closing.
For viewer reference, Medvantage as well as Raksha are acquisitions made by Medi Assist in 2023 calendar year. Now, to try and broadly work this, right? So can a 20% kind of growth rate on this higher top line of almost 800 crore be expected for FY25, or will it take a little bit of time, especially for Paramount to integrate?
So we've always bettered or at least matched the health insurance industry growth rates, Harsh, which have been around 20% compounded growth rates. Given that we recognize revenue over 365 days for every policy, typically you see a little bit of lag between our revenue growth and the premium growth. But on premiums, we expect to continue to track to industry growth rates, because industry itself is expanding very rapidly.
Okay, so 20% doable on this higher top line?
We like to think so, as long as industry is growing at 20%, yes.
Understood. So you'll grow at or above industry is what I understand. Got it. And with regard to what this acquisition brings for you in particular, of course, all the market share accretion always helps. Your group business now, an impressive 36% in terms of your market share in the group business overall, industry-wide. But outside of that, does it give you more pricing power in that sense? Scale, of course, but with it, does pricing power also come to you better?
I think historically, the yields for all the TPAs, Harsh, have been very similar. It's not that pricing was the reason why customers actually switch TPAs, especially in the group business. Group requires a significant amount of high-touch service and technology deployments. And that's where we've differentiated ourselves, and we're already at a 30% on our own. Clearly, Paramount coming in and adding another 6%, taking us to about 37% in group, I think will improve our same-store growth and the retention rates far more. As an example, from the acquisitions last year, on a consolidated basis, we've improved our retention rates from a 92% annum to a 94%. So we like to think that Paramount coming in further strengthens our same-store growth story.
When I'm looking at your balance sheet, of course, large current asset pool, but overall cash on books around the 150 to maybe 180 crore kind of number. You're going to be paying out 312 crore for this acquisition, maybe 4 to 5 months from now, depending on how terms have played out. But you expect to borrow some of this amount? How is it going to play out?
So if you look at us from a consolidated group perspective, we had about 270 crores of cash as of Q1. The enterprise value is 311.8. And then given that we expect the closing to happen sometime towards the end of the fiscal, we should be able to fund this mostly through internal accruals and as needed, maybe a short-term debt.
Understood. And would you continue to acquire companies, because now you are, if I understand it right, larger than the next 3 players in the industry?
Yes, that has been the case for some time now. And so we'll continue to be opportunistic. Clearly for us, it has to make sense from a synergy of revenues perspective and our ability to sort of acquire the business and continue to grow. And then we'll continue to be opportunistic about it. But the story remains predominantly organic and same store growth.
Understood. What does this add to you in terms of, so of course, there are plenty of new clients which Paramount adds to your armor. But outside of that, are there any clients which are largely common with Paramount where you had low-hanging fruit anyway? What does it add to you in terms of unique customers as well as partners?
It's a great question. So thank you. I missed adding that. So today, the good thing is that both of us work with all of the insurance companies on the group business. So there's an absolute overlap from an insurer contracts perspective. But in our business, we are predominantly exclusive, right? So we don't have an overlap in corporate accounts, right? Barring exceptionally rare 1 or 2. So Paramount does bring us almost 3,000 plus, corporate accounts today, with a premium of over 3,800 crores. That's what it brings to us. And the TPA fees and the yields are very similar to ours. So it should only improve our accretion on the same story.
Understood. And do you believe that you've got a good deal with regard to just your disbursement, the valuation that you've got? Because when I'm doing the math just backwards, you've purchased this at less than 10 times 1 year forward EBITDA. I'm just trying to do the math at a 20% margin, of course. And you're currently trading at 20 times plus on a combined entity level, if I'm just again doing the math. So do you believe that you've got a much sweeter deal?
I think it's a very fairly priced considering the size and the scale and the fact that Paramount is the number 2 in the group business. Really, when we look at margins, Harsh, for us, it's more about how we bring in the revenue, move it to our operating model and flip it to our margin profile. So clearly, when you look at it from that perspective, we think it's a reasonably priced deal.
And what are the levers which will help you get those margins at 20% now?
Typically, it's the technology deployment, Harsh. That's where we get a lot of our efficiency. If you look at our employee benefit expenses as a percentage of revenue have historically been about 41, 42%, where for a lot of the industries is closer to a 60%. Right? So there's a fair bit of technology and integrations that we actually leverage today. Clearly, and then we have fairly deep integrations with the rest of the industry, hospitals, corporates, insurers. That gives us the edge in terms of delivering superior service, which is predominantly technology-led. That's where predominantly the margin improvement comes. And of course, then there are other synergies around people and infrastructure, but that's more opportunistic from each TPA.
Right. Thank you so much, Satish. Of course, all the time we have on the show today, but I'd love to have a larger chat with you, and we'll schedule that to try and understand the business slightly better, very unique model. But with that, out of time on this one. Thank you so much for coming in and breaking down those metrics on the acquisition.
Thank you so much, Ash, for having me here. Pleasure.
Right. With that, out of time on this edition. More on the other side. Stay tuned to NDTV Profit.